Gold is sitting right at 44.99, a single digit above the precipice. The 60-minute chart, the 5-hour, the daily, the weekly, all of them are screaming one message in perfect, terrifying alignment. Strong sell, strong sell, strong sell. And yet the monthly chart stands there like a wall of defiance, still flashing strong buy. That is not a coincidence. That is a trap being constructed right now, and most traders will walk straight into it. There is one danger zone and one hidden opportunity today. I will show you both with absolute clarity. Stay until the end. I am handing out 3 exact entry and exit levels you can use immediately, with stops, targets, and the precise conditions that void each trade. Here is your instant market verdict. Gold is in a bearish acceleration phase inside a monthly buying structure. That means we are fading into a deeper correction or teetering on the edge of a structural collapse. The session bias is range-bound with a breakdown skew, and I am treating every bounce as a shorting opportunity unless one specific level gets reclaimed. Write this number down now. 4530. 4530. That is the 5-period moving average on the daily chart and the floor of the previous consolidation. If gold breaks and closes above 4530 on the 4-hour time frame, the entire bearish structure shifts, and we flip to buying dips back toward 4600. Until that happens, I am a seller of rallies, and I am watching the tripwire below. Commit that number to memory or drop it in the comments right now. 4530. Let me see how many of you are locked in. Now let me walk you through the technical architecture that gives me this conviction. Pull up your charts and go to the monthly time frame first. The long-term picture is still a strong buy. Price is hovering above the 200-month moving average, which sits way down around 43.78. That is the ultimate floor, and it is not in play today, but store it in your mind because if we lose 44.88, the next vacuum zone is a rapid slide toward that monthly average. On the monthly, the MACD has been rolling over for months, losing momentum, and that is the bearish undercurrent seeping into lower timeframes. Now drop to the weekly. The week is a firm sell. Price is buried below the 20-week moving average at 45.96, below the 50-week at 46.72, and the 10-week at 45.53 is sloping down, acting as dynamic resistance. The weekly MACD is negative and expanding, no hint of a bullish crossover. That tells me any rally that stays below 45.96 is a dead cat bounce in a bear trend on the weekly scale. Go down to the daily chart, and the picture gets sharper. The daily is a strong sell, and price is currently trading below every major daily moving average except the 200-day, which is sitting all the way down at 43.70. 8. Consistent with the monthly level. The 20-day moving average at 45.96 is the exact same line as the weekly, which makes it a reinforced ceiling. The 50-day is at 46.72, the 100-day at 46.35, and both are trending lower. The daily MACD is at minus 38.88, deeply negative and still widening. The RSI on the daily is at 40.14. That is not oversold territory. It means there is still room to fall before we hit extreme readings below 30. So momentum is bearish and has runway. Drop further to the 4-hour and 60-minute charts. Both are strong sell, with consecutive lower highs and lower lows. On the 4-hour, the 20-period moving average is the immediate dynamic resistance, currently pressing down near 45.30, coinciding with the key number I gave you earlier. The 60-minute MACD is printing fresh bearish bars, and the RSI is bouncing around 40, showing weak oversold bounces that get sold into immediately. This is a textbook bear flag consolidation in the lower timeframes, coiling right above the critical support cluster. Now let me put those levels in your head with absolute precision. Immediate support is 45.12.98, then the major floor at 44.89.97. Those two numbers form the danger zone. Below 44.89, we have a liquidity vacuum down to 44.50, and then 44.20, before the big magnet at 43.78. On the resistance side, the first ceiling is 45.30, then 45.53, then the brick wall at 45.82.67, and the structural breakdown point at 4605.68. A daily close above 4605 would signal the end of the weekly sell trend. We are nowhere near that. The path of least resistance, based purely on timeframes and momentum, is down. The fact that price is compressing so tightly above 44.88 means a violent expansion is coming. This is the kind of compression that produces $200 moves in a single session. The question is which direction the spring unloads. Right now, all lower timeframes vote for a breakdown. But here is what most traders miss, and this is where cross-asset narrative becomes your edge. While gold is coiling for a potential collapse, West Texas Intermediate crude oil is surging on geopolitical headlines and supply disruption fears. Normally, oil spikes feed gold through the inflation and fear channel. Right now, gold is completely ignoring oil's move. That divergence is screaming something crucial. The market is not pricing a stagflationary oil shock. It is pricing a stronger dollar and higher real yields, which are suffocating gold. Look at the 10-year real yield. It has been grinding higher, and the dollar index is hovering near its recent highs, making gold unattractive for both safe haven and inflation hedge flows. The gold versus oil crosscheck tells me the geopolitical bid is being funneled into the dollar and short-term treasuries, not into precious metals. That is a classic late-cycle risk-off with a hawkish central bank overlay, and it is poison for gold. If oil spikes further without gold following, it confirms that gold's real yield sensitivity has taken over the driver's seat, and that is a bearish macro backdrop. Now add institutional positioning to the mix. Gold ETF outflows have accelerated over the last few sessions. The COMEX futures speculative net long position is shrinking, indicating hedge funds are cutting their bullish bets or adding to shorts. The managed money crowd is leaning heavily into the short side on gold, and that is visible in the aggressive selling pressure on every minor bounce. The market is long dollars, short gold, and the institutional flow is validating the technical breakdown potential. Until we see a sudden reversal in real yields or a dovish catalyst from the Fed, the institutional muscle will continue pushing gold lower. This brings me to the trade setups. Most people will skip this section, but this is exactly where money is made. Keep watching because I'm about to hand you the specific entry triggers, stop losses, and profit targets for 3 different risk profiles. And after strategy 2, I want you to drop your own gold range for tomorrow in the comments. I read them, and it shows me how aligned this community is. Let's go. Strategy 1, the sniper. This is the conservative breakdown play. You wait for the trap to spring. The trigger is a 1-hour candle close below the 44.89 support zone. I want to see a body close, not just a wick, below 44.88 on the 1-hour chart. That confirms the breakdown is real and not a liquidity grab. Your entry is a sell stop order at 44.87, giving you $1 of buffer to ensure fill. Stop loss goes at 45.15, just above the minor resistance at 45.13 and above the hourly consolidation high, giving you roughly $28 of risk. Logic for the stop: a move back above 45.13 negates the breakdown and signals a false break trap, so you step aside. Target 1 is 44.50, a round number and prior support pivot from the previous cycle. That is a $37 gain, giving you more than a 1-to-1 risk-reward on the first partial. Target 2 is 44.20, a deeper liquidity level just above the next vacuum. That is a $67 gain, giving you roughly 1 to 2.4 risk-reward overall. When target 1 is hit, move your stop to break even. This setup is voided if gold fails to close below 44.88 on the 1-hour basis, and instead produces a sharp reversal candle back above 45.30. In that case, the trap caught the bears, and you stand aside. Strategy 2, the active trader. This is for those who want to short bounces into resistance rather than wait for a breakdown. The entry condition is a mean reversion move into the 45.13 to 45.20 zone, which is the minor support turned resistance and the convergence of the 60-minute moving average. Wait for a bearish rejection pattern on the 15-minute chart, a shooting star, a bearish engulfing, or a failed breakout with a quick rejection. Place a sell limit order at 45.18, and your stop loss goes at 45.35, above the critical 45.30 invalidation level and above the liquidity of the range. That is roughly $17 of risk. Target 1 is 45.01, the current consolidation midpoint, about $17 gain, 1-to-1 initially. Target 2 is 44.90, at the bottom of the range, a $28 gain, roughly 1 to 1.6. Once target 1 is reached, immediately move your stop to entry and trail by the 20-period moving average on the 15-minute chart. This strategy exploits the sell pressure on rallies and keeps you safe if the range holds. The only thing that voids this setup is a clean 4-hour close above 45.30, which would flip us into a bullish intraday reversal. Let me pause here. I want to see how aligned we are as traders. Type your own gold range for tomorrow in the comments right now. For example, 44.80 to 45.20. Show me you are thinking in zones, not just directions. I read these comments daily, and the best calls get recognized. Do it now, then come back for the high-risk play strategy 3, the Aggressor. This is a momentum chase, high risk, tight stop, only for those who know how to lose small and manage risk aggressively. Given that all timeframes are screaming strong sell and we are sitting right at 44.99 with zero bounce conviction, you can enter a short at market right now, at 44.98 to 4500. Your stop loss goes at 45.10, just above the nearest minor swing high on the 5-minute chart. That is roughly $10 to $12 of risk. Target 1 is 44.90, the immediate support floor, a quick scalp of $8 to $10. But the real target is a breakdown hold below 44.89, where you let the position run with a trailing stop of $8 once the breakdown is achieved. Target 2 on this aggressive entry is 44.50, a $60 extension. The warning: this is counter to the monthly by structure and highly susceptible to a sudden short squeeze. If gold prints a 5-minute candle close above 45.10, get out instantly, no questions asked. This is a high-octane play for traders who understand that a tight stop is the price of admission when front-running a potential collapse. Now, a rapid risk management pulse. Never risk more than 1 to 2% of your capital on any single trade. No positions. Through high-impact U.S. economic data, especially with core PCE on the horizon. Stops are non-negotiable. If you cannot place a hard stop, you are not trading, you are gambling. Discipline is the edge. Let me close with a loop that gives you the single most critical level for the next session. 44.89. That is the number. If gold loses it with volume and closes below on the daily, the next leg down will target 44.20, then 43.78. A breakdown of that magnitude could accelerate gold into a $200 decline over the next 2 weeks, and that would be the trade of the month. But if 44.89 holds and we see a sharp reversal back above 45.30, the trap has sprung in the opposite direction, and we pivot to longs targeting 45.80 and then 46.05. Tomorrow's focus is the U.S. core PCE data and any central bank speaker that could shift real yields. That catalyst will likely be the detonator for this compressed coil. Do not get caught asleep if you want the full breakdown on Bitcoin and the S&P 500 divergence. That video is live right now. Check the end screen, because the correlation fracture there is even more extreme, and the funding rate trap is set. Smash the like button if this analysis gave you a clear, actionable plan. Subscribe and hit the bell for daily institutional-grade coverage on all 8 key assets. I release these every single session day. I will see you in the next one. Watching the trap together.